following is an update and technical analysis on the US 10-year based upon the daily realm, in which today's markets at a glance offered nothing but liquidity-fueled reversals across equities and indices, positioning bonds fundamentally here for the bullish near-term case with core CPI slightly missing expectations and inflation fears fading. Rate cut probabilities completely surged to the upside as the market repriced 2025's monetary trajectory. And add to that the Empire manufacturing collapse and an unexpectedly strong earnings from major banks across the entire sector within JP Morgan, Citi, and Goldman Sachs bolstering sentiment. And with that, you have a potent cocktail for bond demand, where the sharp rally in treasuries, particularly within the belly of the 5-year of the curve, signals a growing consensus across which would call the nucleus to the entire financial constellation, and peak Fed tightening in the rearview mirror, and a market rife with short covering and leveraged positioning. Bonds stand ready to reap the rewards of the face-ripping recalibration based upon what you would call a breakdown sell signal within the technical realm. You have confirmed negative and bearish divergences really constructed amongst multiple key technical indicators, with a bearish crossover within the moving average convergence. You have a nice clean divergent high, nice clean on a bullish falling wedge breakdown off this minor reactionary uptrend price support level. Make no mistake about it, that it is a solidified breakdown. It's solid infused sell signal at the highest order there, overly undercutting the 786 fibs retracement, call it the 4.71 handle. And that was a big key psychological level, call it a multi-year price resistance level that was taken out by bond vigilantes, only to result in a momentum fueled overshoot, trapping any shorts and or bond vigilantes that taken the break to the upside off a bullish cup and handle formation. You can bet that short sellers will be piling in to short the yield on a potential move to the backside on a backtest revisit, which would look invisibly bearish for bonds on a great risk reward ratio short of the US 10-year for 6.3% crash, ultimately reflecting upon dual price support levels. The alignment of easing inflation fears, weakening economic indicators, and surging rate cut expectations creates a perfect storm for bonds to rally, with the market aggressively unwinding shorts and positioning for softer growth outlook. Bonds are primed to outperform in the near term as investors seek refuge in stability amidst shifting economic narratives. Short sellers of the bond want to see a complete false breakout as bond vigilantes retake that space on that handle, ultimately negating the big breakdown sell signal on a prolonged move to re-challenge the 5% handle, which will indeed begin to break things.